welcome to Unit 7 of Finance. And this is your online instructor, Diana Blah. And we're going so fast. This is week 7 already. And this week, we're going to talk about capital budgeting. And capital budgeting is really a continuation of what we've been talking about for the last several weeks, last 2 to 3 weeks for sure. And let's talk about what is capital budgeting. Capital budgeting is the process that companies use to rank their potential expenditures or investments. And when we talk about ranking, here's the situation. Companies, just like people, only have so much money to work with for investments each year, each period. And there's a limited amount of funds to upgrade facilities, to purchase new equipment, to invest in new product lines. Whatever it is a firm is trying to do, there's a limited amount of money to do that. Whether a real or arbitrary capital, there is a cap. There is a cap to how much money can be spent. So there's a limited amount of money, and there's infinite numbers of things that could be done with those funds. There's a lot of different choices. We could upgrade the company software. We could invest in a new call center. We could invest in a new product line. There's so many things a company can do from year to year that are going to cost money. So what we have to do in the process of capital budgeting is to decide where should we spend the limited funds that we have. What will be the best projects that will give our investors the best return for their money? Of all the things that we could do, let's rank them and see which ones we should do. So this is not like working capital where you're just buying supplies and inventory. We're talking about big investments where money is going to be tied up for quite a bit of time. So once we make this investment, we're stuck with it for a period, or it's not easily undone. So these are capital expenditures when we're talking about purchasing new equipment that may cost millions of dollars, or rebuilding existing equipment. Maybe purchasing vehicles, doing some construction, purchasing new buildings. These are the kinds of things we're talking about as far as capital expenditures. And so our capital budget is our plan for which capital expenditures we're going to go ahead and make. And so what we've been talking about the last couple of weeks is time value of money. And we've talked about that money has a time value, and money today is more valuable than the same amount in the future. And that concept applies when we're talking about capital budgeting as well. Because as we discussed, when we are investing in whether it's equipment or new products or real estate, our capital is going to be tied up for some time. So we no longer have use of that. So we want to make sure that we invest in projects that are going to grow our money at an acceptable rate. And any money that we don't have access to today, we want to make sure these projects are compensating us appropriately for the fact that they're taking up some of our money. And so what we do with the capital budgeting process is we calculate the project's future profit for each period. So we're going to determine what is the cash flow that we're expecting from these investments, and then we'll discount those cash flows to find out what that cash flow's value is in today's dollars. So each project has to be evaluated based on how long it takes to get the initial investment back, how much risk there is in the project, what cash flows are expected, so that we can get a value of a specific project, which will help us to determine whether it's worth spending that money on that particular project or not. So the concepts that we've studied as far as time value of money play directly into our capital budgeting process in a large corporation where we're planning out how we're going to spend the money that we have available to us. Now, when we talk about this capital that we're using, whose capital is it? Where does corporate capital come from? Well, when we're talking about a corporation, which we are in this class, we're talking about other people's money. The corporation is a separate legal entity under the law, but it's owned by the shareholders. So any capital that the firm has actually belongs to the owners of the firm, which is the shareholders. So a corporation has two places basically that they get money. And the first one is they can borrow money. which means it's the bank's money. They have to pay it back, and that's debt. So any money that's been borrowed is debt, and when you look at it in theory, that means we're using the bank's money. So if we're going to use the bank's money, the bank's going to charge us interest, and so we'll have to pay the money back plus interest. So whatever it is that we do with that money that we borrowed from the bank needs to pay us enough so that we can pay the bank back plus the bank's interest rate, and hopefully also make some value for the firm. So we can't just take that money and invest it in any project if it doesn't cover at least what our costs are for using those funds, because it definitely costs us interest to borrow money. The other source of funds that we have is equity. That is the shareholders' investment in the firm. People have bought shares in the firm, and those shares were purchased for a certain amount, and so they have purchased a specific amount of ownership by investing money in the firm. So equity is the shareholders' money. So when we're using the shareholders' money, we don't have to pay the shareholders interest, but they are invested because they are expecting returns on their investment. They expect the stock to appreciate. They may expect that at some point there will be dividends, but in any case, dividends or no, they're expecting an appreciation of the stock, and they expect their investment to grow. And so whether we're using the bank's money or the shareholders' money, we have to carefully consider how we're going to spend other people's money, because we owe them something for using their money, and we have to invest in projects that are going to generate enough returns to satisfy our investors or the bank and create growth for the firm. So that's the basis of what you're going to be studying here in Chapter 10, is we're going to look at how the concept of time value of money helps us evaluate what projects are worth, and then allow us to rank them so that we can invest in the right projects using other people's money so that we can satisfy our investors or our debtors. And so capital budgeting encompasses this whole process of planning out each period where we're going to invest the funds that we have available to us. Your assignments this week are going to be on the you've got the practice problems similar to last week, and online, everything's online. You don't have any additional written assignments. Everything's going to be online just like last week. And you do have practice problems that'll help get you ready for the actual assignment. You have a discussion topic that is due this week. Then you've also got an additional video that I want to make sure you watch, because that video is going to help you to use Excel to do these calculations for you. In your textbook reading, you're going to see the manual process for determining the internal rate of return or the net present value or profitability index. But Excel will also do these things for you, and if you use Excel correctly, that'll cut down on mathematical errors and things like that. So that video, if you're not familiar with those functions in Excel, will walk you all the way through how to do those calculations. So I highly recommend that you watch that video in addition to this one. And so if you have any additional questions, though, of course, just go ahead and send me an email or contact me online through the Blackboard IM anytime that you see me in the green, or you can email me anytime and I'll respond quickly. So have a great week, and I look forward to talking to you in the discussion.